When you like a company and you wish to add it to your portfolio, you generally have the option whether to buy the stock or the bond from that company. The stock sits lower in the capital structure of a company, and as a consequence, it should compensate you for the higher risk it carries. Sometimes though, you get overcompensated for this risk. So how can we find out when we get overcompensated? So when we should buy the stock rather than the bond? First of all, we need to look at how much we would receive if we were to invest in the bond of a company versus how much we would receive by investing in the stock of that same company. In other words, how much we should expect if we were a bond investor versus how much we should expect to receive if we were an equity investor of that company. The earnings yield gives us a good approximation of how much we can expect to receive if we were investing in the stock, while the yield to maturity gives us a good approximation of how much we can expect if we were to invest in the bond. One thing to consider here is that an equity investor generally has a quite long time horizon, and as a consequence, in order to compare the yield you should get from the stock with the one you should receive from the bond, we use long-dated bonds, say for example a 30-year bond. Now, let's try to make an example. Look at the chart on your screen. In this case, we are trying to understand whether today we should buy the equity or the bond issued by Microsoft. If we decide to buy the equity, we can expect to receive about 5.6% per year, while if we buy the bond, we can expect around 2.8%. This is your starting point, and your starting point is telling you that the stock is paying you twice what you would expect to receive from the bond. Now, the next step is to understand if this additional return the stock is offering you is attractive or not. In order to do so, we just look back at history, and we can see that actually, as an average, the stock has been offering 3.6% more than the bond, and there have been instances where the stock was actually paying you around 8% more than the bond. These are the times where there is exceptionally more value in the stock versus the bond. So it doesn't seem that the 5.6% that you would expect to receive from the stock is attractive versus the 2.8% you would expect to receive from the bond. In this situation, you probably should buy the bond rather than the stock. Of course, this is a very basic analysis, and there are many other things you should take into account. For example, you can compare the yields you get from Microsoft with the yields you get from other similar companies. You can also use different valuation metrics, like dividend yield, free cash flow yield, or other yields. Also, one thing that is very important to look at is the future earnings growth. It might seem that the equity stock is paying far more than the bond, but if you expect lower earnings going forward, probably it is not the right time to get involved in the equity of that company.